Hi, Sue here from Scott Properties Group. We're back here having a nice chat with Luke Yu from Heartwood Financial in Umundy, which is in the hinterland on the Sunshine Coast. How are you going, Luke?
Good, thanks, Sue. Welcome back.
Good. Yes, it's good to see you again. Thank you for joining us. There is a question that has been coming up recently from our perspective as well. I'm sure it's one that you get asked regularly. So in general terms, do you believe you can get more return on investment via property or via the stock market?
And look, what a great question, and it is one that comes up quite a fair bit. Naturally, people are always looking for the best of return on investment on their capital that they put out there. So whether or not property or shares, look, you're going to find experts on both sides of the fence. For me as a financial planner, we're indifferent in regards to whether we want our clients to necessarily undertake property or shares. It's going to vary between clients. Each has its own characteristics in regards to what you can expect from the investment, such as levels of risk, dividend yield or rental yield, as well as potential capital growth. In particular with property, there is no one property market, as you would know. It's going to vary amongst quite a few regions and style of house and commercial, residential, things of that nature.
Absolutely.
Just so to throw a blanket over and say, hey, what are we going to get more return on, be it property or shares? It's a little bit tricky. You know, you can take any period of time and we could go, well, look, in this particular period of time, shares outperform property, and vice versa. We can see what's happening in the Sydney market at the moment compared against the Australian Stock Exchange over the last 3 months, being January through to April 2019. Share market performed. Even with losses in the Sydney market in the later quarter of the 2018 period, we can see that the stock market actually performed less. Now, the thing there is these are small windows of time. And both of the investments that we're talking about, being property and the share market, are generally long-term holds for your mum, dad investors and things of that nature. So to discuss which one would be better, I think it'd be best always that if a client came in, had a bit of a sit down, we really discussed what their objective is. The final thing that I would say to that is that traditionally in Australia, when it comes to property, people most of the time lend to get into that property. So they go and purchase their $600,000-$700,000 home and they'll only have a $140,000 deposit. What we find is that mum and dads don't generally go out and do the same with shares. Now, what this means is that the return on the investment from their initial investment is generally going to be higher from a property purchase because they're only putting up $140,000 but getting an exposure to a $600,000-$700,000 asset. So this is what we call a geared investment. But people don't really look at it in that sense. So traditionally speaking, if people are comfortable with that type of borrowing and gearing and taking on the bigger asset and have a longer period of time, that can perform better than say the share market if they're investing in just the specific capital without any borrowing.
So do you find when people come to see you with that kind of question that they have a very fixed in their thoughts processes, or do you find that you can actually, turn them around a bit?
Yeah, look, really at the end of the day, it's not my job to kind of sway a client in either way, but yes, they do. We generally see a lot of people coming in, they might go straight for investment properties because that's what mum and dad did and that's the traditional Australian thing to do. We would discuss their very different options and it may very well mean that they end up with a property because it's the right choice for them. I find if a client understands the strategy that they're working towards, they're more likely to hang on to it and keep on with the strategy even during tough times. And if that means bricks and mortar and they can touch it, feel it, see it, and that means that if the market was to slump, they can hang on and keep going, then that might be the best option for them.
So I suppose the answer to that question is that there's no real answer.
Of course.
And one size doesn't fit all. So it's really about working through with your client.
Yep.
Thank you, Luke. That's a great opportunity to get that kind of information from you. Thank you very much indeed.
No worries.
We're going to be catching up with Luke again in a few weeks' time, and we will be chatting on the benefits of having personal insurance and life cover and income protection cover. It's something that everyone needs to relook at frequently, I think, to make sure that it's where it needs to be. So for the time being, thank you, Luke, for your time. We really appreciate it. Thank you, viewers, for watching this educational video, and we will catch up with you again soon. Bye for now.
Thank you.